So we'll start with VRM 6, measuring credit risk. Now, again, just like operational risk, this is also very technical chapter. Okay. And we need to understand that there are some certain formulas. Like, for example, there is a one factor model, there is Vasicek model. So these formulas are quite important, but unlike other chapters of quants, okay, where we have, you can say, the detailed derivation of those formulas, the detailed understanding of the formula. Even over here, Garp has tried to provide sufficient illustration and, derivation of only some steps for those formulas. Uh, but still, there will be segments where, rote memorization will be necessary because, see, if you don't know how to use the, say, tools of calculus, then there will be certain sections which will not be easy to derive. Of course, you can understand it. Okay, what are the steps? What is exactly going on? Okay. When we talk about the worst case default rate formula, what exactly is that formula calculating? That you will know. But then where have all the parameters come from? Why rho is equal to AI square when I teach that thing? Okay, then why rho is equal to AI square or A square? Okay, why that one factor model has been prescribed like that? All those things are beyond the scope of the curriculum. Okay, so focus on the important part, the application part of the formula. Now let's start. So these are the learning objectives. We just skip this part. Okay. Yeah. So a bank must keep the capital for the risk that it is taking. And when losses are incurred, they come out of the equity capital, right? And it's quite obvious. If losses are incurred, they have to come out of the equity capital. Banks have debt capital as well as equity capital, and the debt capital is almost always subordinate to deposit. So see, who has the first claim on the resources of a company? Forget a bank right now. Is this true for any company in general? Is this true for any company in general? That the first claim on the company's resources is of the creditor for belongs to the creditors, right? So if at all the company goes bankrupt, let's say, if the company goes bankrupt and certain kind of restructuring takes place, or let's say if there is the company cannot continue even with restructuring, then whatever assets are remaining, those assets will first be serviced to the debt holders, okay, or the creditors of the company. If at all something is left after that, then only it will go to the equity holder. So that's why the debt capital is always it will go to the equity holders. And inside debt also there can be different kinds of debt. Okay, now let's come to the special case of banks. Banks have the most common, in fact, when we talk about retail banking, the most common form of the liabilities of the bank are short-term deposits. That's also a kind of loan that the bank has taken from the depositors, right? So even under debt, there is seniority level. Okay, even under the loans or even under the liabilities, you can say there is seniority level. So you can say that these deposits, the short-term deposits, have the highest seniority level. And then any debt taken from the debt holders after that, maybe long-term, longer-term debt, that will also be subordinate to these short-term or highly liquid deposits that the bank is taking. Now, credit risk has been traditionally the most important risk taken by the bank. Now, this goes without saying, right? Credit risk, without any doubt, is has been the most important source of risk for any bank traditionally. Okay, now over the last 15, 20 years, particularly in the last, I'll say 15, 10, 15 years, in fact, but yeah, this started after 2002 only, that operational risk has also been recognized very, very widely. And in fact, nowadays, the analysis tells us that the biggest source of losses from the bank's perspective is actually from operational risk events. And next comes the credit risk event. But traditionally, credit risk has been the most important risk by the because that was the main idea behind the banking system, right? What the bank does, the bank basically takes in, you can say, deposits and goes for, say, long term. loans as assets. Okay, so mainly it's all about credit risk. What will happen if the counterparty defaults? That was the most important source of risk. Okay, now let's start with a little bit of background about the Basel Committee also. Now, in 1988, the Basel Committee, in fact, first, before discussing this in 1988, what was the scenario before 1988? Now, before 1988, there was actually no regulation, you can say, proper set of regulations. Okay, every country was uh, relatively free to choose how the regulations were done, okay, in its own country with respect to the banking system. And it was mainly, traditionally again, it was mainly about certain ratios that all the banks had to maintain with respect to, say, capital to assets, assets to debt. Okay, then there was hence liquidity ratios were different, solvency ratios were different. So all these ratios were the main thing that were, you can say, that those were precursors to the proper formal regulations which happened before, uh, which happened in 1988. In fact, 1988 actually, this committee which was formed, the Basel Committee. Okay, this Basel Committee was actually formed earlier than that. Okay, there were many countries, particularly the G10 countries. They wanted to synchronize, you can say, global banking regulation. Okay, and then they had agreed on this common approach, which was known as the Basel One, that underlines a common approach for determining the required credit risk capital for banks under their supervision. Then in 1999, the credit risk regulations were proposed under Basel II. Even today, they are extremely relevant. They still underlie the credit risk capital calculations. Of course, some things have changed. The approaches have changed a little. Okay. But overall, the main pillars, the main ideas are still true with respect to capital allocation, capital calculations, and it features a standardized approach and an internal ratings based approach. Now, between 1999 and 2019, the implementation of Basel II and, of course, further regulations, Basel 2.5 and Basel 3, have taken place. Now, if you see the regulations, again, as the regulations have progressed, actually more and more focus has shifted to operational risk. So that is why under operational risk, we have a number of chapters in part 2, FRM part 2, we have a number of chapters with respect to the Basel regulations. But since market risk and credit risk were already being paid attention before only, okay, so of course there will be many chapters in credit risk also where you'll find mention of Basel regulations as per requirement. Now, let us start with the idea of economic capital. What is economic capital? Economic capital is a bank's own estimate of the capital that it requires, okay, to tolerate that amount of risk, which is actually, which we'll see later on, what kind of percentile we see for risk. So, now there are two kinds of capital, of course, most of you know that. Economic capital is own estimate. What about regulatory capital? Regulatory capital is the regulator's estimate. Okay. So bank's own estimate versus regulator's estimate. Now, both of these capital calculations, they have, regulators may use a different model, bank may use a different model. So there are, the calculations are generally different for all the categories of risk: capital, sorry, credit risk, market risk, operational risk, liquidity risk. Okay. So for uh, economic capital, one thing which is very, very important is actually the correlation among the assets in a bank's credit portfolio. Okay, so what are the different classes of assets, or even under the classes or under a single class of assets, what are the different credits that the bank has on its balance sheet, and the correlation between those instruments and the risks posed by those instruments, those become very, very important. Okay, so correlation is quite important. Now, there is another model which we'll see, credit metrics. Credit metrics is a model which can be used to calculate the credit risk economic capital, which we'll see in detail, okay, especially the theoretical part. And one of the features of this model is that it considers losses from both credit rating downgrades and loan defaults. Now, see, there are multiple methods which can be used to determine economic capital. Some of the methods may take correlation into account, may take downgrades into account. Okay, some of the methods may just take defaults as the only source of risk for a counter. Because see, uh, the earlier thought process was that unless and until the loss does not materialize, it does not need to be accounted for in the capital allocation part. Okay, so basically the probability of default is important. But now credit metrics extends this idea, and even a credit rating downgrade is considered as a significant credit event. Okay, which is also that the probability of that also, the probability of credit rating downgrade also is incorporated in the calculation of economic capital via this credit metrics approach. Okay, now let us see some data on defaults. Okay, so this is a table. Annual percentage default rates for all the rated companies is shown from 1970 to 2016. This is again average, annual percentage average default rates for all rated companies. We'll also see some other tables as well. If default among a bank's borrowers were independent of each other, then the default rates would be similar each year. And then binomial distribution could be used to model the defaults. Okay, because the binomial distribution, there were two conditions, two main conditions, if you remember. Can anyone remind me from quants? What were the two conditions under at least two conditions? In fact, there were five conditions. If you see one of the doubts which I have answered on the LMS, I have given certain more ideas also how to understand that this question demands a binomial distribution solution. But yeah, still two main conditions are very important. Two very important conditions. Very good. Very good. Very good. So two outcomes itself is binomial. That I was actually it's quite clear that okay, binomial distribution means two outcomes. Very good. But conditions. What are the two conditions under which we can apply the binomial distribution? Remember Bernoulli? We started with Bernoulli. So Bernoulli was based on a single trial, correct? Bernoulli was based on a single trial. Okay. But when we extended it to binomial, there were n trials. But there was a keyword between n and trials. Remember that keyword? That keyword was independent. So that is one of the most important conditions when we talk about binomial. Yes, there are two outcomes. That is correct, absolutely. But then the conditions when we are talking about, the first condition is that the events, okay, or the results in the trials, or simply the trials are independent of each other. The probability of the first of any outcome in the first trial will not affect the next or the subsequent trials, right? They were independent. And the probability of success was constant across trials. So these were the two very important conditions. P is constant and they are independent. The trials are independent of each other. So in this case also, if you assume that defaults are independent of each other, okay, then obviously you can use the binomial distribution unless and until another condition that the average probability of default is also constant across the years. Okay, which again, these two assumptions are very loose because in practice, the loans do not default independently of each other. And rather, there are good years and bad years for default. So there is a lot of clustering. Default events actually clustered together. Okay. So that is why this assumption is quite loose, but still, I mean, for theoretical purposes to start with, it's not a bad idea. Okay, to at least give you a model, a basic model, it's not a bad idea. Another assumption was that probability of default is constant across years. That is also a very uh, assumption which does not hold true in the real world. Okay, now what kind of distributions we can use? Just like in operational risk, we learned about mainly when we were doing Monte Carlo. If you remember, we were stitching two distributions. Again, let me just ask you guys so that we can have revisions wherever required. Which two distributions we were stitching in Monte Carlo simulation in operational risk? Tell me. Perfect. Poisson and Perfect. Poisson and log normal. Very good. So Poisson was for the frequency or severity? Of course, one is for frequency, one is for severity. Very good. Poisson for frequency. So it means that log normal was for severity of the losses. And we actually stitched those two distributions together to get our final Monte Carlo simulation graph, right? So in this case, we talk about the same log normal distribution. The log normal distribution is used to provide an approximation or approximate fit to the data of default. Credit contagion risk is then the risk that through microstructural channels, the credit deterioration of a counterparty triggers the credit deterioration of other counterparties. So basically, now we are talking about systemic risk, or you can also say systematic risk. Okay. Systemic risk is created when a very large counterparty, which is very important to the market. Okay, it has a lot of transactions with n number of counterparties, or you can say it has major transactions with even one another major party. Even then, the default of this main party, the one of the counterparties can trigger the deterioration of other counterparties as well, and that is what happened in the financial crisis, right? The importance of credit contagion for non-financial companies is still debatable. Okay, because non-financial companies, uh, since they are not directly related to the business of, say, either direct retail, wholesale, commercial investment, whatever kind of banking or any kind of finances. Okay, so that is why the importance of credit contagion for these kind of companies is not 100%, you can say, uh, mm, I'll not say proved because that is not a correct word. It has not been 100% observed by whatever data we have seen. Then you have the Vasicek model, which we'll see later on. It relates the probability of default to the value of a factor. This factor can be considered to be a measure of the recent health of the economy, and we'll see that. This part, as I told you in the beginning only, you understand that, okay, this is the one factor model and what factor we are talking about, and then how Vasicek model uses that one factor model. But why that one factor model is the way it is, the derivation is not there. Okay. Okay, let's continue. Now, this is the idea. This is the graph where you have a distribution of losses. Okay. It's a very simple idea. Very simple idea. During a 1 year period, loss over 1 year, it is mentioned. It shows the entire distribution. What distribution? Probability distribution of losses during this 1 year period. Okay. So you will have two kinds of losses that you are interested in. The one is, of course, the expected losses. So this will be the basically mean of the distribution. Okay. And since it's a log normal distribution, you can clearly see that since it's skewed towards the right, the mean will also be pulled from this part, okay, where you have the mode. So mean will be pulled towards the right. So that is why you have expected loss over here. Okay. Then you actually consider another loss as well. You consider a very high percentile of the loss distribution, X percentile of this distribution. Okay. And then the difference between these two is actually the capital for unexpected losses. The difference between these two is the capital for unexpected losses. Now, I strongly believe that, in fact, we don't have time for that entire discussion of the proof of Vasicek model graphically. Sometimes it's actually, in fact, the visualization of the Vasicek model graphically, it makes a lot of sense. And I'm not a big fan of this diagram that is presented everywhere, almost everywhere. Of course, Garp has used it. It's also mentioned in the regulator's book also, if I'm not wrong. So the problem is that, it does not give a clear-cut picture of this worst case default rate because, okay, anyways, I'll come to that. First, you understand that which loss we are considering over here. So we consider this as a very high percentile of the loss distribution, a very, very high percentile. Okay. See, expected loss is very clear. Expected loss is the loss which is expected, as the name suggests. Okay. And those of you who have or are working in the banking sector, expected losses are already accounted for in the cost of doing business by the banks, correct? How do they do it? How do banks account for expected losses in the cost of doing business only? Correct, pricing, absolutely. The level of interest rates which are set, okay, of course, that will determine the pricing of the securities that they're issuing. So, the level of the interest rates that is being set by the banks, particularly for lending purposes, that incorporates that, okay, this will be the expected losses. So they calculate the expected loss per default per say, and I'm just giving a very layman example. Let's say the total expected loss is say $1 billion or something like that, total expected loss. So that will be distributed across the number of say number of counterparties based on, of course, their proportional interests, and then proportional stake. Basically, interest means stake, not interest rate. So based on their proportional stakes in the portfolio, you can distribute the entire total expected loss, and you can add some amount of interest rate to cover that expected loss. So basic, a very basic layman idea I'm giving you. So that's quite clear that it is already incorporated in the expected loss only. But of course, unexpected loss are not accounted for in the cost of doing business. Now, this is where you actually have to keep, the bank has to keep that extra capital as the buffer capital, you can say. Like, for example, if at all this loss hits, this loss level hits, then what capital the bank needs to absorb that loss? That is the economic capital. And that is the difference between expected loss and the X percentile, or the very high percentile loss. Okay. And this X percentile is set by the Basel committee as 99.99 sorry, 99.9%. So basically the bank should have sufficient capital, according to the regulator, of course, that it is able to cover losses 99.9% of the time. So 99.9% is nothing but 999 by 1000. So 999 out of 1000 times the bank should be able to survive. Okay. So only 1.1% of the time, or only once in 1000 times, the loss will actually exceed to an amount which is not covered by the capital. But 999 out of 1000 times, it will be covered. That is the idea of this 99.9%. Okay. Now, this is the formula for expected loss. In this is the first part is in percentage terms. Okay, we don't have any dollar amount as yet. So only in percentage terms, if you want, this is the expected loss. In dollar terms, you will multiply it by the amount of exposure that the bank has towards one or several counterparties in general. So let's take an example. Let's say this is the data we have. PD is given, RR is given, uh, EAD is given. Can you tell me in terms of dollars, what is the expected loss in dollars? Okay, before you guys continue, you can start any, but we can just discuss. There are two doubts which have been asked. Is this loss distribution purely based on bank's internal data, or any external information is also added? There actually a lot of external information is relevant with that. The model can be internal, but the data, okay, can be sourced from many external sources. Data can be from rating agencies. Data can be from vendors which can be purchased. Data can be publicly available on the counterparty's website. Data can be internally generated by the bank research team. Okay. So data is definitely, it is actually used from various sources. The model can be purely internal. Okay, Vedant. Lucky is asking, will this concept be tested numerically? Yes, it will be tested. It can be tested numerically. And it is relatively simple actually. If you see, it's not a very difficult idea. Okay, Lucky. So just have to be sure that which is the probability part. Okay, you are taking the probability part from the data properly. Parameters LGD. Just analyze the question properly. I think you'll be able to manage a percentile part. Okay. So we'll discuss one example. I think that should also not be a very big issue. With practice, you'll definitely manage it. So yeah, you have got $25 million. Okay, perfect. So it's 25 million, or you can say 0.025 billion dollars. What about percentage terms? Only if I ask you in percentage terms, what is expected loss? What will you say? What is expected loss in percentage terms? Okay, so correct. 0.5%. Okay. Now, let's say there is a bank. I mean, it knows that, okay, its expected loss is 0.5%. And it also knows that the cost, servicing cost, administrative cost is 2%, and financing cost is 2.5%. So based on these three parameters, what is the minimum interest rate that the bank has to charge to break even? So if bank is lending you and the bank's financing cost is 2.5%, the service cost or administrative cost itself is 2%, expected loss is 0.5%. Correct. The minimum interest rate charged should be 5%. This is for break even. And of course, there will be some spread, okay, above this. Now let us come to the idea behind mean and standard deviation of credit loss. Suppose a bank has n loans and we define the following quantities. Li is the amount borrowed in the ith loan, which is assumed constant throughout the year. So if one counterparty has borrowed an amount, that will be constant throughout the year. Pi is the probability of default for the ith loan. Ri is the recovery rate in the event of default by the ith loan. Rho ij is the correlation between losses on the ith and jth loan. Sigma I is the standard deviation of losses from the ith loan, and sigma P is the standard deviation of the loss from the portfolio. Then we actually standardize it. I mean, for each sigma I, instead of calculating each sigma I separately, we also try to find out only a common sigma if we assume all the things to be, some of the things to be equal. Anyways, we'll come to that also. Then we define alpha, the standard deviation of portfolio loss, as a fraction of the size of the portfolio. So in the exam, if this question is asked, it is possible that you might have to calculate any of these three, sigma, sigma p, or alpha. Okay. So let's see how it is done actually. This is the formula for expected loss of ith loan. Probability of loss of ith loan, or probability of default of ith loan, loss given default of ith loan, 1 minus recovery rate for ith loan. It can be derived quite easily using very basic formulas. We have done this in the PDF and the main video, but again, for the class, it's not important. So it can be derived quite easily that the variance of the credit losses is actually given by this. Okay. Again, the very base variance formula has been used, ex square minus ex whole square. If you use that formula, you can get this derivation. So if you take the square root of this, you get the standard deviation. Okay. Now, as I told you, if you assume that the probability of default for all the loans, all the credits is same. Again, the assumption is quite strong in general. First, we'll cater to a doubt that Vedant has asked. Here in the EL formula, we have taken L, the loan amount, but as loans are amortizing, the remaining amount of default should be less than equal to L. Absolutely, but just now, Vedant, that is why I made this point. I highlighted this point. It's a very good doubt, actually. That's why I highlighted this point just now, that the amount borrowed in the ith loan is assumed to be constant throughout the year. That is an assumption. And I said also that's a very strong assumption, right? Okay. So you have uh, the standard deviation. Now, if we assume that probabilities are same, all the PIs are same, LIs are same, and RIs are same for every loan, then of course sigma I will also be same for every loan because the three parameters are same. So that common sigma I will be this sigma. Okay, P minus P square multiplied by L multiplied by 1 minus R. Okay. Now, if you extend or if you want to derive the portfolio variance from this standard deviation formula. Okay, again, we got this common standard deviation formula only when we assumed PIs are constant, LIs are same, RIs are same for every loan. So if we use this idea, we get this common sigma. And if we have this common sigma, we can have the variance of the portfolio also. This is the formula for variance of portfolio. And of course, standard deviation will be the square root of this, no doubt about that. Now, another quantity which I told you can be asked to calculate is alpha. Standard deviation of portfolio loss as a fraction of the loss or as a fraction of the size of the portfolio. Okay. So once you have this sigma p, the square root of this. Okay. If you want to find out alpha, the standard deviation of the loan portfolio as a percentage of size is the alpha. So alpha is what will be the denominator? The total loan size. For each loan, the size is L. So for n loans, the size will be n times L. Okay. In fact, it would have been better if, no, I think this is also cool. No problem at all. Yeah. The standard deviation divided by the, the total loan size. Yeah, it's cool. No problem. Sigma P divided by NL. Okay. So you can take the square root of this as sigma P. Okay. The square root of variance. And then this root n actually, since there was one extra n over here and you take the square root of this. So if you see square root of n can be taken as common. And that is why we have cancelled square root of n from the numerator and denominator. And you're only left with one square root of n in the denominator. But because denominator was square root of n times square root of n. There were two square root of n's. Okay, it's n. So n is nothing but square root of n times square root of n. So that's why one of the square root of n's disappear. Again, the derivation is not important. Okay, if you have this only, even if you remember only this formula, you know what is alpha. Alpha is nothing but sigma p by NL. You don't need to remember this formula, guys. You just remember this. That's it. And you know this, sigma p square. So sigma p square, and this sigma p by NL is equal to alpha. These three you have to remember from this slide, okay? So let's take an example. Let's say you have N is, there are 100,000 credits in your portfolio. 100,000 credits is a huge number. It's a very big bank. For each credit, the loan size is $1 million. It's massive if you see the portfolio, 100,000 times 1 million. It's huge. It's not a small bank. Probability of default for each credit is 1%. Recovery rate for each credit is 40%. The average correlation between the credits, it is again assumed to be same for each pair, is 10%. This is the formula for sigma. Can you calculate sigma quickly and send your answers? Come on, take it as a practice session on calculations and send your answers quickly.
Sir, we are not able to hear you. There is a known voice coming from your end.
Oh, so sorry. So since when? Since okay, since only this time, right? When they
This,
send the
this,
answers, right? Okay, okay.
yeah.
So and I was saying this. In fact, I gave a lot of no thoughts also on Nitin's answer. Okay, sorry. That okay, that's it's too. See, 18 million was a high number, Nitin. I was saying because this 100,000 was not featuring anyways because we are only talking about sigma for a single credit. Okay, so that's why 18 million was on the higher side. You got the correct answer, Nitin. Now $0.0597 million. Nitin, you got the correct answer now.
So is this for the uncorrelated? Because I have made an assumption for uncorrelated.
No, again, we are talking about the standard deviation of a single credit. So where does correlation even come into the picture? This sigma, if you apply this formula directly, you can see this sigma is the standard deviation of credit losses for a single credit. So
Okay, I have
only
for
1
complete
million, yes.
portfolio basically.
No. For a single credit, that's what I told you. And that's why I said since 100,000 is not featuring into the calculation, so
Okay,
you don't need to worry about that. You only need to calculate this sigma.
okay, fine.
Okay.
Yeah.
So you get this as 0.0597. For alpha also, I was saying, whichever version you are comfortable with, I was saying that, you can just start with sigma p from here. Sigma p square you can calculate. You can take a square root of that. And then you can divide by NL, or else you can directly use this version and tell me what is the value of alpha quickly. Just the calculation part, you just send the correct answer.
Sorry, can
So
you come again, sir? What exactly you want to check?
I want alpha, this quantity. Sigma p by NL basically, or this. Both are same. So once you calculate sigma for each credit, then you will calculate sigma p. And then you divide by NL so that you can get alpha. So this is the formula. So my point was that either you use the direct formula, the rightmost formula, or else you can first use the formula for sigma p by taking a square root of this, okay, like this, and then directly dividing by NL. So you don't need to remember this part of the formula. But since I have already given it to you, take it as a calculation exercise and just send your answers for alpha. Now, Vedant asked a question we can ignore the minus one from the n minus one terms as well for portfolios with a lot of accounts. Yes, absolutely yes. It won't make a difference at all. Correct. In fact, in the sigma p formula only, Vedant, right? Because alpha's formula is an extension and you can say of the sigma p formula only, right? So yes, definitely. Definitely. It's a very good point, actually. Very good point. So I'll just explain what Vedant is trying to say. He's saying that if n is huge, okay, in this case it's 100,000, it won't make much of a difference in the answer whether you take 100,000 minus 1 times rho. So 99,999 multiplied by row or 100,000 multiplied by row. The good part is if you ignore minus 1, this minus 1, your calculations become simpler. Correct, Vedant? That is the whole idea, right? Behind ignoring minus 1. You have to, that some kind of objective has to be served. It's a very good point actually from your side that you can ignore minus 1 completely. Yes. So that you get answer quickly. But yeah, if the answers are way too close, let's say only till three decimal places, the only difference you're seeing in the fourth decimal place, okay, or even let's say in the third decimal place, starting from that, then it can be risky. So in that case, you have to have -1 also. But generally, I think it's a very good idea. I don't think they'll give so close answers on the choices. It's a good idea. So you're getting how much? 0.0188. 1 can be removed from the square root. Hmm, correct. That can also be done. But then there is a problem with Vedant. I think if suppose you remove 1 also, so in the numerator you'll get root n times rho. correct? Root n, exactly. So you'll just get square root of rho multiplied by sigma divided by L, correct? Yes, yes, yes. So that also you can check. What is the approximation? Can you tell me if you use this approximation that you are saying? Again, this is creating a problem. Just a minute here. Let's just go for the approximation. Sigma root n is cancelled out, right? Root of rho divided by L. Just see how much you are getting. 1 plus, because if you see rho is 10%, okay, 0.1, and then yeah, it won't make a huge difference. Again, I agree with you over here also, but the inside term will, this term will make very less difference. So this can be very safely ignored. This you have to be a little careful when the answers are close again. Okay. But still you'll get a decent enough number, which is not a bad number here. In this case, it can be quite close. Yeah, so you're getting very close, right? Point 0. Why 10 to the power minus 6? Okay, because of L. Because of L. Yeah, but then there's a problem, right? We actually are getting alpha as 0.0189. Correct? If we do the full calculations, we are getting 0.0189 only. There is no 10 to the power negative 6 in the picture. Can you check if this calculation is correct or not? Exactly, it's 0.01888, correct? Which is almost the same, right? Just check the calculations once again, Vedant. 0.0597 is same. Okay. Square root of rho we are getting, right? There is a problem. We are trying to cancel. Getting this, so 10 to the power minus 6, you're not getting. You're saying with the approximation also. So if we actually, okay, finally, okay, got it. So it's great then, right? Fine, no problem. We can go for the approximation sometimes. Okay. L is $1 million. Let us just discuss this once again, because in the exam there should be no mistake, right? So once you do sigma square root of rho by L, in the numerator you have, of course, something which is 0.0189 only. I think in the numerator only you are getting, right? And in the denominator you have 10 to the power 6. So obviously you should get a factor of 10 to the power negative 6. What about this? This entire thing 0.0189, or this entire thing is also 0.0189 times 10 to the power minus 6? Because see, if we do this with that, I'm not able to get this. If we are doing 0.0597 multiplied by square root of 0.1, okay, divided by 10 to the power 6, which is 1 million. Correct? So obviously you are getting 0.0188 multiplied by 10 to the power minus 6. What about this entire thing? Are we missing the picture? In this case also, are we getting 0.0189 multiplied by 10 to the power minus 6? Am I missing a factor over here? That's what I'm asking. This calculation, just do it once again properly. So you have 1 plus, just do this exact calculation. You have 99,999 multiplied by 0.1. And then you add a 1 to it. So that is why I was same value from both roots, right? Okay. So that's basically this is wrong, right? It should be multiplied by 10 raised to the power minus. Is this correct now? Okay, great. Fine. Then it's okay. Now this table and figure, it displays the relationships between alpha and rho. So obviously, as rho increases, alpha will also increase. But a very important point which can be asked in the exam. Alpha is the standard deviation of the portfolio as a percentage of the total amount or NL. So basically that standard deviation as a percentage of total amount is increasing as rho is increasing. The rate of increase is highest over here because the graph is more steep. The slope is higher as compared to this. This is gentler, this is steeper. So the rate of increase of alpha with respect to rho is higher for small values of rho. So over here in this zone for small values of rho, 0, 0.2 till 0.3, it is decently, decently paced. And then the pace is decreasing gradually. It is flattening. Okay. So that is the idea. Now to calculate the bank capital using the model, rho is an important parameter which has to be estimated, right? We had rho in the calculation of sigma p, right? In the calculation of sigma p, you need to have rho. Only then you can have the unexpected loss. So correlations can be estimated from a bank's historical data. Also, rating agencies estimate the correlations between the default rate of two companies as a function of their rating. Okay. So as a function of their rating also, how they have rating as changing with time, how correlated they are. Even if you have a correlation between their rating, that can be a proxy for the correlation between default rates as well. It's a very good proxy because in the one of the ratings matrix, which we saw in external and internal ratings, you remember there was default. If you see, remember the full table, there was a default column as well. And in fact, the ratings, how they were changing every year, that was also displayed. The calculation of unexpected loss requires an estimate of a high percentile of the loss distribution. And in this case, Monte Carlo is applied. Now, the distribution of the losses, the underlying distributions, they are not very clear. And of course, they cannot be same. So what we do is we use this Gaussian Copula model. This has to be covered in detail from extra lecture correlations and copulas, which is uploaded on the LMS only. Because it's from part 2, they have just given this idea that how we are doing it. If you want to do the go for the exact process, which is not a part of FRM part 1, you can refer to this video, extra lecture. Okay. Again, only for those who are curious about the process, how it is done, how the mapping is done. The idea I will tell you right now. Suppose you have two distributions, V1 and V2. If their distributions, underlying distributions are not known, then each of these distributions, V1 and V2, they can be transformed to a standard normal distribution, U1 and U2 respectively. So V1 is transformed to U1, V2 is transformed to U2. Okay. So U1, U2 both are standard normal distribution. Standard normal distribution means normal with a mean of 0 and standard deviation of 1. This is done by a process of percentile mapping. So the fifth percentile of this V1 is mapped to the fifth percentile of the standard normal distribution. First percentile to first percentile and so on. And then since you are interested in the joint distribution, why you are interested in joint distribution? Because when you talk about credit risk, if you have more than one credit, let's say if there are two credits only, then in the beginning only we discussed, see that defaults are not independent of each other. They cluster together and one company's default might trigger the default of another company. Okay. So that is why how the joint distribution of defaults can be visualized, that is very, very important for this model. That is why you are interested in the joint distribution. This is a very simple case where only two underlying distributions are shown. For multiple credits, you will have V1, V2, V3, and many underlying distributions will be there. Okay. Now, the first thing that we need to discuss before we apply the actual model, the Vasicek model, is the one factor model. Okay, this is basically the objective is to create a model by which we can dare to define the correlation, I should say, between the different UIs distributions. Okay, because if there are multiple, in fact, many underlying credits, so correspondingly there will be different underlying distributions, and there will be there will be different correlations between each pair, right? So that is one of the big problems. So that is why one factor model is one of the solutions where you'll be able to understand, not understand, again, I'm wrong, because as I said, that understanding is beyond the scope of the curriculum. You will be able to implement the idea and you'll be seeing which of the parameters can be prescribed as a proxy for correlation in this model. So it assumes that UI is a combination of two parts. UI is a combination of two parts. The first part is AI multiplied by F. Okay, and the second part is square root of 1 minus AI square multiplied by Zi. What are these actually? Based on the model, what the model assumes these are. The model assumes that this but F is a factor which is common to all the UIs. And that's why you can see there is no subscript to F. It's not Fi or Fj. It's just F. Okay. So basically, there is a common factor which has been taken, which relates all the UIs together. Okay. Then you have Zi, which is unrelated to the common factor. And also Zi and UI are also uncorrelated. Okay. Now look at the idea economically, how it makes sense, or based on financial modeling, how it makes sense. Um, it is assumed, let's say you have a bank, uh, it has a number of counterparties, and the portfolio is quite diversified. Quite diversified. From capital asset pricing model, do you remember which kind of risk was being taken and it was basically tied up to the risk for all securities? We discussed two types of risks in
Default
capital.
risk.
No, no, no. We discussed two types of risks in capital asset pricing model chapter. What were those two kinds of risks in CAPM? By the way, CAPM is also a one factor model only. Perfect. Systematic and idiosyncratic risk, or you can say systematic or and unsystematic risk. So, which was the common source of risk for all the securities? Very good. It was systematic risk. Idiosyncratic was company specific, correct? So, this is the idea, the same idea. Economically, that's why it makes sense because for all the credits, for all the counterparties, there will be a common market factor, a macro factor, okay, a structural factor, you can say, which will affect all the securities, just like the market factor of CAPM, systematic risk. And this is the company specific factor. which is uncorrelated to the market factor. Okay, so that is the idea behind this one factor model. And of course, for the sake of simplicity, F and Zi are assumed to have standard normal distributions, which will be, of course, normal distributions with mean 0 and standard deviation of 1. And AIs are parameters with values between -1 and +1. Okay. Is the idea clear? What is the idea behind this? Can we try and compare this to that CA? By the way, CAPM is also one factor model because only one factor was there, if you remember. In fact, APT, we introduced several factors. CAPM was only having one factor, right? ZI, Vedant is asking, ZI represents the system. No, no. F represents the systematic risk. ZI represents the idiosyncratic risk, Vedant. Okay. Lucky is asking, what does alpha signify? Lucky, which alpha? This alpha, the previous example that we were doing over here, this alpha, or something else you're asking? This is just a parameter which is calculated. Standard deviation as a percentage of the total portfolio size. In fact, that's it. Standard deviation as a percentage of size. That's alpha, a parameter which banks use to assess what is the standard deviation with respect to the total loan. That's it. So alpha, the utility of sigma p is same. Basically, it signifies what is the variance of the portfolio per unit of dollars. That's it, of the total loan size. Got it? That's the idea. Nothing else. Sigma p divided by NL, that is alpha. Okay, so you can say it's a derived quantity. It's an implied quantity. It's not a directly interpretable quantity. Because if you want to interpret properly, you interpret sigma p properly. Alpha is just the sigma p divided by NL. That's it, nothing else. Okay. 10 to the power minus 6 came in the calculation. That's what we found actually. You calculate this, aren't you getting this result? Because 1 million is 10 to the power 6, right? You calculate this. This is the calculation. So basically, you're getting 0.0000000189 like this. 0.7 zeros and 189 because 1 zero is already there. You will have 6 zeros from here, 10 to the power minus 6 because there is a division over here, right? You're lucky. It's it's again I'm saying see it this was a special case, I'll say, where we had this heavy value of n and this heavy value of L. Okay, so generally this will not always be the case. So banks, if the banks require this parameter, then definitely it is significant for them. Okay, standard deviation as a percentage of total loan sizes. So they feel that it's significant. And it, of course, most of the time with N and L being large, this alpha will be smaller and smaller. And the smaller it is, if you see in terms of risk, see, if you measure only standard deviation, we got as 0.0597, 0.0597 million. But if you compare it with the total loan portfolio of the bank, you realize that, okay, there are many, many credits, and as percentage wise, this standard deviation as a percentage of the total loan, it's not a massive number. Understood? It's not a massive number. That's the idea. Okay. I still think there is a mistake over here. See, I got it now. Vedant, I got it. There will be no 10 to the power minus 6. That's why. I mean, there will be no 10 to the power minus 6 over here. Why? I'll tell you just now. There was an issue. See, that's why I was a bit concerned that time. This 0.0597 we got, Vedant, was it in dollars or was it in millions of dollars? This part. In dollars only or millions of dollars? You have million over here. Millions of dollars. Okay. Yes. So it means that this is in millions. So this will also be in millions. And then this and this will cancel out. Clear now? So you only, whether you use the shortcut or you use this full formula, or whether you use this formula, because this is in millions. The sigma itself is in millions. So 1 million gets cancelled. Got it now? So the answer will only be 0.0189. Okay, thanks, Lucky, for asking this question. At least we found this error that we were making earlier. Okay, clear, Vedant? Million is getting cancelled out. We are not getting 10 to the power minus 6 anywhere. Whether you use the approximation or use the full formula. Is it clear to everyone? Yeah, we missed the million. Correct. So very good question, I'll say, and sharp observation. He thought that, okay, if this is such a small number, will it even be significant? Good observation. So let's go. Yeah. So now we were discussing that how this one factor model, again, let's make sure that we are able to relate this and apply this to our finance and credit risk segment. That is the idea. Mathematical derivation, as I told, it's not there. So you don't need to worry about that. So we were discussing about CAPM. I told that CAPM is a one factor model, right? It only has one market factor, one common market factor. Now, in that model, the correlation between the returns from any two stocks is guaranteed, or in fact will be assumed. I mean, if the model is also, there is a lot of assumptions. So based on the assumptions, it is actually guaranteed that the correlation between the returns from any two stocks will occur completely from their dependence on a common factor, that systematic factor. So in this case also, it is assumed that the correlation, and based on the structure of the model only, you can see that there's a common factor and the correlation between different UIs. So the correlation between UI and UJ, they will completely arise because of their dependence on a common factor. Okay. Again, see, it may or may not be correct. The assumption may or may not be correct. I'll tell you an example, a very specific example. Let's take, say, TCS and say Wipro. Let's try and find out the correlation between TCS and Wipro, and let's compare that correlation with the correlation between TCS and, say, Maruti Suzuki. Okay, or Maruti only, because that's how the listings are done, right? So TCS and Maruti, that is one correlation, and TCS and Wipro is another correlation. So when we talk about TCS and Wipro, both are Indian IT giants, right? So yes, there will be correlation between them due to a common factor. Common factor F. Definitely yes. No doubt about that. But apart from that, apart from the common factor of the market, they are still correlated, right? Both are IT companies. Both are affected by similar events, similar outcomes, right? Wipro, in fact, has other areas of venture as well, but The main is IT only, right? Right now also we are seeing the prices are actually of both the companies are going down simultaneously, right? Because of the advent of AI, they have lost so many contracts. The biggest strength of TCS, we heard this that the biggest strength of TCS is actually its bench strength, and that is why TCS was able to bag huge number of contracts, and it was able to retain them also because clients knew that come what may, TCS will never default, you can say, on the service or delay the service, at least because of this manpower issue, because they have so much of manpower. But with the advent of AI now, since many projects are being directly, done outsourced to AI apps, AI softwares, AI powered websites, okay, AI powered agents. That's why a lot of changes have happened in this segment, in the software segment, consulting segment, and Indian IT giants are facing the wrath, right? So it is not only about a common factor F, right? In the sector wise also they are correlated, right? So there will be some idiosyncratic risks which also will be common to TCS as well as Wipro. So rho due to the ZIs will also be there in this case. So this is an exception. These are exceptions which are not covered by the one factor model. And there are too many exceptions, right? Like this, because it's not a one off exception. Exceptions not implied or covered under this one factor model. But in general, if you talk about the correlation between TCS and Maruti, what do you think? Of course, there will be a correlation due to F, but will there be correlation due to an idiosyncratic factor? Will they have too many common factors? Company specific common factors? Will they have too many common factors? No. As compared to the relationship between TCS and Wipro, they don't have too many common company specific factors. Okay, not really. Correct, Vedant. So that is why this one factor model can be applied to most of the companies, which are in different sectors basically, and they don't have ZI any correlation between their idiosyncratic factors. Okay, but still, this one factor model is a decent enough model based even whatever assumption it is having, it is still a decent enough model. Okay, so this one factor model can also be applied to default probabilities. Okay, and this factor F will be assumed to be a variable which is related to the overall health of the economy, as I said. And that overall health of the economy affects the default rate. So F directly affects the default rate. So basically, when the economy is down, a lot of defaults will happen together. Okay, and UI will be pushed more towards the left side. Okay, so now after this, what we do, we make some more simplifying assumptions. We assume that AI is also equal to A for all i's. The AIs are assumed to be same for all i's. Okay, so I just write AI, subscript was missing. AI is assumed to be same for all i's. So which means that UI is equal to A times all the A's are same plus 1 minus A square multiplied by ZI. Okay. And based on this model, okay, one more thing I want to write over here. It also can be derived that the correlation between UI and UJ based on this model, the correlation between UI and UJ can be derived as AI AJ. AI times AJ is the correlation between UI and UJ. So again, in simple terms, basically only this part. Just multiply these two AI and AJ because their relationship is a common factor. It is AIAJ. And of course, it can be derived also mathematically. It's quite easy to derive it. Once all the AIs are small, it means AI equal to AJ equal to A. Okay, so that is why the correlation between each pair UI and UJ becomes A times A, which is nothing but A square, because AI and AJ both are same as A. That is the idea. Okay. Now, as we discussed, this factor F can be thought of as an index of the recent overall health of the economy. If F is high, the economy is doing well, and of course, if this is high, this will also be high. Okay, which will make defaults less likely or unlikely. And if F is low, the economy is doing bad, all the UIs will tend to be low and defaults will be relatively more likely. Okay, there's a question, I think. See, A is an entity, a parameter which is assumed to be between -1. That's why I said why this has been framed in this way. The mathematical part is not a part of your course. You can just assume that AI is a parameter with values between -1 and +1. It has been chosen in this model because if AI is chosen like this, there will be a lot of statistical properties which we can work on. Okay, and which it will satisfy. This is just the model assumption. That's it, Vedant. Okay. And so if you see the mathematical part, if you analyze it properly using high level mathematics, you'll understand quite easily that okay, this AI makes sense because there are some statistical properties. Once you do this square plus this square, AI square plus square root of 1 minus AI square whole square. AI square minus AI square get cancelled out, only 1 is remaining. That's it. Okay. So F represents the current state of the economy, you are asking Vedant, but do we also capture the expected future state? Somehow, to some extent, yes, just to a little extent. Because today's health of the economy will definitely influence tomorrow's and day after tomorrow's health. So maybe 1 month, 2 months, whatever the magnitude of the effect is, it will definitely percolate. But the issue is, yeah, over here, Vedant. The point is, when we say recent health of the economy, if we are projecting right now, and if we are assuming that, okay, F can be this and F can be that, then we are assuming that in the future, the health of the economy will be this. So if it's an assumption, then definitely we are directly predicting the future or we are assuming things about the future. But we already know, let's say once the value of F is approximated or known, then you can say that even after today, even after the current period for which it was approximated, even after that, it is relevant, definitely relevant. Okay, so AI is equal to AJ, so we have rho is equal to A square. And for each value of F, this distribution has a mean of AF and a standard deviation of under root of 1 minus A square. For a large portfolio, the default rate is the probability that UI is less than N inverse PD. And this you will get. Now, the idea, I'll tell you the idea behind this. See, the denominator is the standard deviation. You see this formula. This is actually X, this is mu, and this is sigma. This is nothing but X minus mu by sigma, which was the Z value, if you remember. Now, if you take N, you will get the default rate as a function of F. X minus mu divided by sigma. And this is the visual idea behind this. If F is very, very small, okay, if F is very, very small, it means in a very, very stressed or worst case scenario happens. Then obviously based on the formula for you will be small as well. Okay. But when that u will be sufficiently small for a default to take place, when that u will be sufficiently small, We can find it by calculating ui and comparing it with n inverse 0.01. Why this n inverse 0.01, guys? Because the Basel Committee, and in fact, most of the industry practices, they have established this 99.9%. Okay. And this 0.01, in fact, we'll come to 99.9% later on. Let's start with first 0.01 only. I'll come to 99.9% also. If this particular scenario, in this case, if the probability of default is equal to 1%, it means that you write like this: the company defaults if, or you can say in 1% of the cases, and the company does not default in 99% of the cases. So if you want to model it using a distribution, and we are only talking about a single company, which distribution we are using? Only a single company. Two options. Either default will happen or no default will happen. Tell me the best distribution to you to model this. Either the company will default with a probability of pi, okay, or the company will not default with a probability of 1 minus pi. Which distribution are we talking about? Two outcomes only for a single company. Bernoulli. Vedant, I said for a single company. That is why Bernoulli. Had I told you that for n companies, independent, where the defaults are independent of each other, then it would be binomial. In this case, it is a Bernoulli distribution. So what they have done, remember Gaussian Copula? In Gaussian Copula, what we did? We mapped the distribution of defaults to a standard normal distribution, correct? So in this case, we map this Bernoulli to a standard normal distribution. So default happens pi percentage of the pi with the pi probability, and no default happens with a 1 minus pi probability. Okay, so this is the original, say this is actually the binomial Bernoulli variable, say v. This can be mapped to a standard normal distribution. If pi is equal to 1%, let's say, then this is 99%. It means if you map this to a standard normal, it is very clear that in the no default region, you should have how much percent of the area? In the no default region, you should have how much percent of the area? 99%. And in the default region, you should have 1% of the area. So that is why we are doing n inverse 0.01, because to the right of n inverse 0.01, okay, or to the right of minus 2.33, you will have 1% of the area. And to the right of minus 2.33, you have 99% of the area. It's quite clear from the standard normal. That's why we are doing it. Okay. So basically, based on this mapping, as of now, we are only doing the mapping, right? Remember, we are only using the Gaussian copula, using the Gaussian copula approach to map this Bernoulli distributed VI to standard normal UI. Which means that according to UI, if UI is less than negative 2.33, default will happen. If UI is greater than negative 2.33, default will not happen. Okay, that is the idea. And that is why it is quite clear AF, since AF is the mean, actually, again, these things can be derived quite easily. Since AF is the mean of AF, okay, so mu is AF. This N inverse PD is X, again, this part. Okay, so X is this part minus mu divided by sigma. Okay, so basically this thing is the entire mapping only. So X minus mu divided by sigma. X will change continuously, okay, based on changing PDs. Because if you are talking about a single value of PD, it is, we can assume it to be 1%, 2%, whatever. But if you want to talk about the whole distribution of PD, Of course, PD will take all possible values, and that is why x minus mu by sigma will take all possible values. And once you take the n of it, you will get the entire distribution. So the same idea, basically, whatever visually I showed you, that you are mapping Bernoulli to standard normal, and this is the mapping process only. Okay, when we are doing it. Okay, UI is less than n inverse PD, and from the properties of normal distributions, this is the default rate as a function of f. Okay, the now let's come to the crux of Vasicek model. As of now, we were just showing you what tools will be used for the Vasicek model. Now, Vasicek model is used by regulators to determine the capital for loan portfolios. It uses the Gaussian Copula model to define the correlation between defaults. The Vasicek model has the advantage that the unexpected loss can be determined analytically. When the probability of default is assumed to be same for all the companies in a large portfolio, and the correlation among defaults is also assumed to be constant, the worst case default rate, or 99.9% of the default rate distribution, is given as this. WCDR is equal to n. Again, this formula, it will take some time to derive, but it's not a part of the course. So from the exam point of view, you just have to remember this formula. There is no substitute, because as I told you, rho is nothing but a square. So that's why we have actually written, instead of square root of 1 minus a square, 1 minus rho is written. So basically rho is equal to a square. And also if you see, this is also x minus mu by sigma only. So if you will ask me, sir, then why plus? Why not minus? Because we are using the property of normal distribution over here. N inverse of 0.999 is equal to negative of n inverse 0.001. That was the property of normal distribution, if you remember. So basically you have this root rho is nothing but a. Okay, this is the worst case of f, worst case part of f. That is why we have taken it as 99.9% worst case. Okay, what will happen to f in the worst of the worst cases? That is the 99.9% VAR in terms of f we have taken. How bad can f go at 99.9% confidence? You'll have n inverse of 0.999 negative, basically. In fact, a negative n inverse of 0.0001, because that will be to the left of this. N inverse 0.0001 is the area to the left of n inverse 0.0001. Okay. But since the property is this, so this negative sign was actually replaced by a positive sign. And everything else, if you see, is the same. This formula is actually the same. A square is rho. Okay. This is x. N inverse PD is x minus the mean divided by sigma. Okay. But again, I have a problem, as I said, with this version of the formula. You know what I feel? And this version of the diagram also. I told you in the beginning, I'm not very happy with that diagram which they draw when they show worst case default rate, and they show expected loss and unexpected loss and the difference between them. Okay, and I'll tell you why. First, I'll show you the formula for unexpected loss, and I'll tell you why. Okay, before that, there's a doubt, I think. Let me check. Direct numerical based formulas, like numerical based questions, most probably. That will be the idea. Okay. So unexpected loss is this. And again, derivation is quite easy. You use this formula. Unexpected loss is equal to quantile loss, this worst case loss, minus expected loss. This was the unexpected loss, which is nothing but WCDR multiplied by LGD times EAD, minus expected loss formula was PD multiplies by LGD multiplied by EAD. Now, I said that I'm not very comfortable with this diagram as well as their derivation of the formula like this because it implies something very strange. And you'll see the irony, you'll see the contradiction when I say this. Vedant is asking, can we also calculate? Yes, in scenario analysis, you can do everything, Vedant. As of now, it is just changing the probability part. Okay, Vedant. We can definitely, when you go for scenario analysis, you can also manipulate EAD, LGD. This model does not do that. This model is purely based on the probability versus WCDR. Okay. Now, I'll just tell you an irony, a contradiction over here based on this diagram. See, this diagram is being represented in such a way that it conveys a message that, EL as well as WCDR, that QL, they are actually being calculated from the same distribution. Hmm? Right? That is the assumption, or you can say the implied conclusion, you can say, based on this diagram. Because see, you have QL from the same distribution, you have EL from the same distribution. But the problem is, if it is the same distribution, then don't you think worst case default rate, the probability of going to the worst case should be even lower than the probability of normal average probability of defaulting? Don't you think that? Listen to my words very carefully. I said that, don't you think that if you simply consider both WCDR as and PD as probabilities, don't you think the probability of going worst case is actually higher as compared to the probability of normal probability of default, which we'll call as unconditional probability of default? Because as you are seeing, I mean, if you see this diagram, obviously the height is much lower over here, the height is much higher over here. Okay, but there is a problem. See, for continuous distributions, the height is not the probability. We always have a range. Okay, so that is one problem with this approach. Another contradiction is that this WCDR, in the first intuition, it will seem that this is actually lower than PD because the worst case scenario will have a lower probability. Agreed or not? Are you understanding what I'm trying to say? The worst case scenario, don't you think it will have even a lower probability than the average default scenario? Yes or no? Exactly. Default. When that is why when we talk about higher default rate, exactly. The problem is that you feel the probability of happening would be lower, right? So since these two are probabilities only, right? If you see, this is a probability, na? This is also a probability and this is also a probability. So don't you think this number will come out to be negative if this is smaller than PD? Yes or no? Compare WCDR and PD only in probability terms because WCDR is probability only. Do you agree that it will become negative if WCDR is less than PD? If I tell you the average, yes, exactly, less likely to occur, right? No, but this is probability only, Vedant. This WCDR itself is a probability. That is what we are assuming. That is what we are calculating also. It's a probability. N of something. It's a probability. Okay. So intuitively, if you see, the probability of worst case should be lower and the probability of average case should be higher. So obviously this number, worst case default probability and probability of default, normal probability of default, if you compare them, WCDR seems to be less than PD, but that is where the problem lies. They are not using the same distribution, guys. WCDR is actually based on a conditional distribution. Okay. And PD is an unconditional probability of default. So WCDR tells you, actually, it is asking another question. It is asking a question, if the market factor F becomes very, very low, then what will be the probability of default? Obviously, it will be higher than the normal probability. Because under normal circumstances, probability of default will be less, but under stressed circumstances, the probability of default will be much, much higher. So I believe that this entire approach of using the same diagram, same loss distribution diagram, just calculating that this as the difference, it doesn't make sense because the WCDR in this case will always be intuitively implied to be less than PD. Is my point clear? What I am trying to say? Are you able to understand what I am trying to say? Vedanti wrote, yes, WCDR would be less likely to occur. So answer my question. If WCDR is a probability which is less than the PD, UL will be negative, na, in that case. Correct, Lucky. So UL will be negative. It's a contradiction. UL cannot be negative. It's wrong. That is why this diagram approach is wrong. It falsely leads you to believe that WCDR is actually less than PD. But in reality, that is not the case. Because they are not the same distribution. WCDR and PD are not applied on the same distribution and they are not derived. WCDR, in fact, is a conditional probability. So it should use a conditional distribution of default. And that is why WCDR is actually higher than PD. WCDR tells you, no, no, model does not fail. Again, I'm saying just the way of explanation is wrong. This diagrammatical explanation that they have given in the book, that is not fine by me. Okay. They are not even referenced from different point in time, Labanjit. See, the idea is this. Yes, there should be corresponding distribution. So I'll just draw, okay, over here. See what I'm, yes, yes, it is given in OR also. But since it was discussed in great detail over here, that's why I'm raising this point in this credit risk part only. See, the idea is that when you talk about probability, when you talk about probability, this is the unconditional probability distribution. I'll also apply some algebra also, which we studied in chapter 1. Again, these things are not a part of of the course actually, that is it is given anywhere. No, it's not given, but it's better that you understand it because I'm just relating it to whatever we have done in QTA1. Unconditional probability of default, PD, is equal to, if suppose I consider two scenarios. There is stress in the economy where F is low, and there is no stress in the economy, F is normal and high sometimes. So can I just break this down into two parts? Can I say that this is equal to conditional probability of default during stress multiplied by the probability of stress? Okay, in fact, I don't need to write C. You would understand that it's PD stress. Yeah, this is better. So probability of default under stress multiplied by P stress plus probability of default under no stress multiplied by P no stress. Do you agree with this breakup that I have done? Again, in a very layman terms, yes or no? If suppose there are only two scenarios, stress and no stress. Do you remember the name of this formula? What we used to call it? There was a theorem, in fact. Yes, excellent. It was the theorem of total probability. Okay, so we are breaking it into two parts. Now, when I say WCDR, actually WCDR is this probability, guys. Correct. Okay, but the problem is, but then one thing you mistakenly written. See, again I'm saying you wrote WCDR is a conditional probability. That is correct, Vedant. You wrote given that it is a non-BAU scenario. That is also correct. But then when you are writing whereas PD is the BAU scenario, that is where you are going wrong. PD is both the combination of BAU and non-BAU. That is PD. Understood now? So conditional probability is basically conditional on the fact that there is stress. But unconditional combines both. And if in fact if you use numbers also, every time you will find that most of the time, in fact, with correct practical numbers, this PD will be much less than PD stress. And it logically also it makes sense. Okay. So I said that if suppose we are using this PD, okay, we are mapping this, and this is our PD distribution mapped to a standard normal distribution. This same distribution cannot be used to find out what is the worst case default rate. That is another distribution. That is a conditional distribution, okay, which will have a different mean and different standard. It will not be a standard normal distribution. The conditional distribution will be something like this. Okay. It is also a standard, it is also a normal distribution, but it's not a standard normal distribution. The mean has shifted, the standard deviation has changed. And then WCDR is basically this area. So WCDR is the probability to the left of something, but in the conditional default distribution, where we know that this distribution has been made under the assumption that economy is in stress or F is small. So this is the conditional distribution. So the difference has to be very, very clear. Okay. And as far as this form, this is concerned, I said there is a contradiction and you can say an irony. The explanation is not, it does not align with the probability part. But if you see this diagram now, and if you only consider the amount of losses, then this diagram is okay because you forget the probability in this diagram. This diagram I'm talking about. Where is the Vasicek model diagram? Sorry. So sorry. I think it was over here. Yeah. Uh, what happened to the diagram? So sorry. So sorry. I think it was actually, yes, this diagram I was talking about. So sorry. Yeah, it was it. This diagram, you should not look at the probabilities. This diagram will be correct only if you look at the x-axis or only the losses over 1 year. So the difference between the horizontal coordinates or the x coordinates, this difference is okay. But the mistake that candidates make, they also confuse the same diagram with the probability also. Because if you see probability part, then you'll normally the intuitive first intuition will come into your mind that okay, the probability of hitting expected loss is obviously lesser. Okay, it's 1% based on whatever average PD is given. But the probability of getting a worst case loss is even less than this lesser expected loss, I should say, or a loss with a lesser probability of expected loss in itself is a loss with a lesser probability. So only 1% of the time this loss will be getting hit. But this actually worst case loss is happening with an even lesser probability. But these two, when we talk like this, then we are referring to both of them in unconditional terms. We are not considering that, okay, F is down. After that, we are calculating actually the worst case default rate. So this is the issue that I'm having with this diagram. The same diagram is interpreted both in the context of losses also, x-axis also, and the probabilities also, which is unfair. It is quite unfair. Okay. Now Vedant is asking, is there a way to include the timing aspect, that is stress and non-stress scenarios, in a single distribution? I don't think so. It's possible. Okay. I think again, the problem is that the message will not be conveyed properly. It has to be a conditional distribution, Vedant. See, of course, you can, no, but in a single diagram, how will you do it? How will you visualize it in a single diagram? It's not possible. Okay, you're saying time it. No, 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 no. See, that is only this formula then. Then this formula, whatever I wrote over here, then it is incorporated. The stress and no stress part of the formula, which I've written, conditional and unconditional. This part, yeah, this is enough. This tells you both. This side is unconditional. Unconditional PD, which will be given in the question. This is WCDR finished in the same formula. Okay. And it's not only a point of time. It's not only about time. Okay. Stress and no stress. Although, again, it will be intuitive that at one point in time you can have stress. You're assuming the other point of time you're not. No, basically, we are assuming stress and no stress. That's it. Time doesn't actually even matter. Even if we assumed, say, one point in time or another point in time, it doesn't matter. Stress and no stress. Those are the two arguments. Okay. Fine. So this is the idea. And this is the formula for Vasicek. And this is the unexpected loss. As I told you, the issue with this diagram is that you should not interpret this diagram in terms of probabilities also. You should only interpret this diagram in terms of x-axis, horizontal axis, or the actual amount of losses. So this is a log normal distribution basically. And the for understanding the probabilities, use the standard normal distribution, which was the unconditional distribution. And for the conditional part, use a conditional distribution, conditional normal distribution with a different mean and standard deviation. Yes, scenario weighted. Correct. Correct, Vedant. Scenario weighted probabilities. That is what we wrote. Correct. Okay. Yeah. So one more thing which can be analyzed over here is the relationship between PD and rho or vice versa. Okay. And WCDR also. Sorry. And vice versa also. And the combined effect also. In fact, this particular table focuses more on the combined effect. What happens to WCDR once these values of rho and PD are increased? Okay. For the calculation part, if you want to calculate, we can just demonstrate one of the calculations. So if we want to calculate, say, this 9.1%, this one, this is the calculation, guys. Just very straightforward. N inverse 0.005 plus square root of 0.2, N inverse 0.0009, sorry, 0.999, not 0.000, 0.999. Basically, we have taken PD as 0.5%, so 0.5% over here. Rho is zero point 0.2, so 0.2, zero point 0.2. That's it. Very simple, basic calculations, direct formula. So, okay, got it, Lucky. So, direct formula based questions can be asked from this. Okay. You can clearly see that the 99 percentile or the worst case default rate increases with both PD as well as rho. And this is quite high. Once PD is 2% and the correlation is 80%, then the worst case default rate becomes 94.4%. This is too high. Okay. Now let us see another model, which is the credit metrics model. A credit matrix is also used by banks. Okay, there's another question, I think. Yes, yes, yes. Mostly it will work, but see, I still feel there are the discussions that we had. Those are very fruitful discussions. Okay, the difference, the whatever part you could understand, understand that also. Okay. So this credit matrix is also used by banks to find out economic capital. Now, under this credit matrix model, each borrower, each borrower is assigned. Okay, got it. No problem, Baki. It's okay. If you're not able to understand this completely, also, if you're able to solve the numericals, I think it should be well and good. But at least the parameters, what are the parameters? What is the foundation of the model? What is F? These part you can understand, na? Overall health of the economy. What is the meaning of worst case default rate? Okay, what is the difference between conditional and unconditional over here? So all these things are important. So each credit is actually assigned a rating. That rating can be internal or external. Okay. And then you have the transition table. Now, this transition table basically is a subpart. It can be derived quite easily from the transition matrices. If you remember, we did this in VRM 4, external and internal rating. So the same idea. That table is used to just uh, modify. Actually, that table has been modified a little for a single company, basically. For a single company, we have done this. A B-rated borrower. So this B-rated borrower has a 5% probability of going to A, 80% probability of staying B, 13% probability of going to C, and 2% probability of defaulting. Okay, now what I have done, I've given you the cumulative probabilities also. Okay, I've given you the cumulative probabilities also. Why we have given cumulative probabilities? It makes a lot of sense because we want to know that if suppose we want to know the scenario where which will happen less than or equal to 5% of the time, less than or equal to 5% of the time, a transition from B to A will happen. Okay, between 5% and 85%, you have B will remain B. Why we are doing this mapping, I'll tell you, and why we are finding out this cumulative probability, because we want to visualize this. We want to map this to different regions in a standard normal distribution. Okay. So if the cumulative probability is 5%, then you know that the corresponding Z value is negative 1.645, because to the left of negative 1.645, you have 5% of the area. Okay. Similarly, the corresponding N value, you can see the Z table and you can check for 0.85, you will get plus 1.036. It means to the left of plus 1.036, you have 85% of the area. So 80% is between these two. So this region signifies B staying B only. Blue region similarly signifies B going to C, and this region signifies defaults. Okay. Now what happens is simulation takes place. In each simulation trial, the ratings of all the credits, because see, if you remember, I told in the beginning only when we were introducing credit metrics, we discussed that some models may use uh, actual defaults only, but some models, and in fact, this is true for most of the modern models, they will use credit downgrades also as credit events. So rating changes also are important. So in each simulation trial, all the ratings of all the credits at the end of 1 year, because these are 1 year transition matrices for the data from that only, they are determined, and then the portfolio will be revalued completely. That is the whole idea. Okay, and of course, if the portfolio is revalued, then how will you calculate the credit loss? The value of the portfolio at the beginning of the year minus the value of the portfolio at the end of the year. Okay. Now, how do you carry out the simulation? See, on each simulation trial, you actually draw a sample, a random number from a standard normal distribution. Randomly you draw. Okay. To find out what can happen to this B-rated borrower. So, if your random number from a normal distribution comes out to be less than negative 1.645, then this rule will be that the rating transition has taken place from B to A. If your number if your number from the normal distribution comes out to be negative 1.645 to 1.036, which has a very high probability of 80%, then you will assume that the rating transition does not happen. It will stay at B only. Then again, between these two, you will assume that the transition has happened between B to C, and greater than 2.054, you will assume that there has been a default. So this is the idea behind credit metrics. Okay. Now let's go to the next part, which is risk allocation. Now there are some mathematical properties which have been used, and a mathematical function. The Euler's theorem has been used. Okay, for you, I will say that let's focus on the application. What is expected out of you in the exam? That is what is important. Okay, so homogeneous, basically this lambda comes out of the bracket. That's it, nothing else. You define this qi is equal to xi divided by delta fi divided by delta xi. And of course, xi can go in the denominator, where delta xi is a small change, delta fi is the resultant change in fi. Here, qi is the ratio of delta fi proportional to a change in this. So it's basically like you can just relate it to duration, something like that. Of course, in the duration part, if you remember, it was delta b by b in the numerator, and it was delta y in the denominator. In this case, it's the opposite actually. Okay, the proportional part is in the denominator now. Anyways, now it was shown by Euler that as the value of delta xi gets smaller and smaller and smaller, okay, f becomes equal to summation of qi. Again, to understand this, just directly go to the example. The theorem and the derivation, that is completely out of the scope of the curriculum. Okay, the application part will be asked. So I don't think from this slide they'll directly ask any question. I think the real picture comes from here. In the context of credit risk, Euler's theorem can be used to determine the contribution of each loan in a portfolio to the overall risk measure. To illustrate this, let us take a very simple example. So this is the example which has been taken. The same example which is there in the main video and the PDF. So these are basically the correlation values between different loans. Correlation or covariance, let me check. I think it's the correlation only. Yeah. 0.7 should be correlation only. I'm not wrong. Yeah, should be correlation only. Now, standard deviations, if you know them, if suppose these three are the standard deviations and the portfolio is equally weighted, then the standard deviation of the portfolio is given by this. Can you please calculate this and tell me what is the answer? Say two of these terms will disappear because row 1 comma 3, the correlation between 1 and 3 is 0. Correct? The correlation between 1 and 2 is also 0. The only correlation which remains is between 2 and 3, which is 0.7. So this part will only remain. These two will be gone. Sigma 1, sigma 2, sigma 3 values you know. Quickly tell me what will be the answer. See, in the class at this stage, just weeks before your exam, if you're participating actively in the discussions, especially say because even if let's say if in the first go you're not able to internalize the formula, but at least it's written in front of you, right? Even if you do the calculations only on the calculator, it will give you good practice. Okay, so please send your answers. Okay, Vedant, let's see what others are getting. Calculate and send your answers. Come on. Anyone else who's getting the answer? Sigma 1, sigma 2, sigma 3. Okay, fine. Two answers at least we have got. So yes, it's actually correct. 1.99098. Okay, or 7 something. So now we'll apply Euler's theorem. Now delta xi will keep it to be very small. Okay, to apply Euler's theorem. So the size of lone 1, that is delta x1, increases by only 1%. Okay, so standard deviation also will increase by 1% if the size of loan is increases by, again, in dollar terms. This 1.1 earlier was also given in dollar terms, right? It can be billions of dollars, it can be anything, but it's in dollar terms. Okay. So if suppose the size of the loan one is increasing by 1%, then this will be the new sigma. So what will be new sigma p then in that case? This will be new sigma p. Okay. Everything else remains the same. The only thing that we are doing is we are just changing sigma 1 to 1.111 instead of 1.1. So over here we had sigma as 1.1. Now we are having sigma as 1.11. Okay. So we calculate, we get new sigma p, the new standard deviation as 1.997078. And this is the difference between the two sigma p's. Okay. Now since delta xi was very small, we find out Q1 first. Okay. And then we'll apply the Euler's theorem. Now, if you remember, the formula for Qi was equal to what? It was delta Fi divided by the proportional change in Xi, right? Now here, the proportional change in Xi, yeah, this part in fact I can write over here. The proportional change in Xi is 1%. So it is nothing but 0.01. So you know what will be the denominator, right? And delta Fi is this. Delta Fi is this. Okay. So now can you tell me? Okay, is my voice breaking for everyone? Like he's saying my voice is breaking. Is it breaking for everyone? Okay. Okay. Lucky is it okay now? Okay. So can you tell me if what will be QI quickly? Correct. Basically, we are just dividing this 0.00698 by 0.01, which will give us 0.6098. Similarly, if you change the size of the loan 2 as well as loan 3 by 1% and then you calculate the same thing, I'm just giving you the numbers, you'll get 0.6924 and 0.6924 once again, because they were same, right? I mean, the value of sigma 2 and sigma 3 was same, right? So Q2 is also 0.6924, Q3 is also 0.6924 because sigma 2 was equal to sigma 3, right? If you remember the question, both are same. Okay, so Q2 and Q3 will also be same as 0.6924. Now, when you add them, Q1 plus Q2 plus Q3, how much you're getting? 1.9946. So the idea is that this is very close to 1.99098. It's not very far. So it's a decent approximation as Euler rule states. So that is the idea. So basically, you are breaking the portfolio standard deviation into the components. This is how we break it. So basically, we can say loan 1 is contributing this much to the total standard deviation, 0.6098, and loan 2 and loan 3 are contributing 0.6924 each to the total standard deviation of the portfolio. That is what Euler's rule application is to the credit risk part. Okay, so that's the derivatives you can cover from the PDF, challenges from the PDF. Okay, anything else from this particular lecture which you want to ask? One doubt is there. Can you please explain the risk allocation theme at a high level holistically? Thank you. Yes, definitely. See, when we talk about allocation of risk, and this part, in fact, is discussed to some extent in investment management module in FRM part 2. So if suppose you have different business units, okay. I mean, again, this is from the perspective of this same logic. I mean, if I talk about business unit, basically I'm extending the same idea of credit risk, risk capital allocation to operational risk also. And operational risk, what we do? You actually see that, okay, this particular division is contributing this much to the overall risk. Okay. That is one aspect. The other aspect is to look at it in isolation, Vedant. Okay, so which is more important? Is the overall contribution of risk of that department, okay, or that business line in an organization more important, or is its overall contribution, or I should say, is its contribution to the overall company risk more important? So, should you look at the overall contribution uh, or the contribution in isolation? Yeah, in isolation or overall contribution. So contribution, yes, because in isolation, if you look at, then you will completely ignore the correlation between different business lines. Okay, and you may tend to underestimate or overestimate the risk. That is the idea. So this risk allocation part, the same logic if you apply to credits also. So either you can consider the credit risk of a single loan in isolation, or you can consider the contribution of that loan to the overall riskiness of the whole portfolio of the bank. Okay, so risk allocation considers this contribution basically. That is the idea. When I said Q1 plus Q2 plus Q3, you can view them as contributions, individual contributions to the total standard deviation. Clear now, Vedant? This is the idea behind risk allocation. Okay, and when the regulatory capital, when the economic capital is assigned, Vedant, yes, yes. And when the economic capital will be assigned, Vedant, then rather than assigning a higher level of capital, which probably could have happened if you would have considered the risk in only isolation, the bank actually is able to optimize its capital in a better way by making sure that it is considering only the risk allocation part or only the total contribution, the contribution to the overall risk, okay, for that particular credit. So Euler's approximation, how is it applied? You're asking now. Euler's approximation is applied in this way that what we do, see, first condition of Euler's approximation is that the value of delta xi as compared to xi. So this overall ratio should be very, very small. And this will happen when delta xi tends to 0. So when you have a very, very small change, then you can say or you can find out what is the contribution of each of the xi's to f. Is it clear now, Vedant? So that is exactly what we are doing. We tried with these loans. We started with these loans. We found out that the overall portfolio standard deviation is 1.99. Okay, or 1.991 you can say. And then what we did, we actually changed the size of each loan. So we made delta and with by a very small amount. So that delta xi by xi is a very small number. In this case, 0.01. So which tends to 0, right? So if that is the case, and we find out the standard deviations in every single scenario, the new standard deviations in every scenario, the new standard deviation in every scenario, if I find out, then I'm going to get delta fi. The difference between the old standard deviation and the new standard deviation as delta fi. Okay. I divide it with the proportional change in xi to get my q1, which is my contribution of 1 to f. Clear now how Euler's theorem is applied? Okay, great. Yes, yes. That was also an assumption. Yes. In fact, this assumption will be true. Why this will be true, Vedant, in this case? Because they are equally weighted. That is why it will be true. This can be proved also. When they are equally weighted, when W1, W2, W3 are same, then this assumption is absolutely correct. Okay, that's the idea. Fine. Okay, so yeah, anything else from this chapter? Anyone? So we had a very detailed discussion regarding many of the concepts. Anything else? Okay, so we'll just end the session then. Thank you very much.